Good afternoon, and thank you for joining us. I'm Anna Pinedo, a partner in the New York office of Mayor Brown, and I'm joined today by Laura Richman, Dave Schuette, and Brennan Young. And the topic for our session today is corporate hygiene, recent developments impacting share buybacks and Rule 10b5-1. We'll go on to the next slide. We'll be talking about the SEC's final share repurchase disclosure amendments, as well as the Rule 10b5-1 amendments. And in light of the fact that we're headed into the year end and companies are starting to think about and prepare for annual report season, as well as for proxy season, we'll be focusing on timely updates for disclosure controls and procedures and things that you may want to start planning for and thinking about with your boards and committees as you head into the end of the year and you start thinking about disclosures, as well as start incorporating all of the amendments that the SEC has finalized during the last few months. Before we get started, I'm going to mention a few housekeeping items. So for those of you who are joining us today for CLE credit, we're going to read the CLE code out loud when it appears during the presentation. We'll repeat it at least once during the presentation. We've circulated CLE forms along with the connection details. If you take a moment and complete those and add the CLE code that we read out or that we show on the screen and send that back to the Mayor Brown email address, we'll return those to you. We'd like to make today's session as interactive and as responsive to your questions as possible. So throughout the session, feel free to type in your questions into the chat box. And as we go through the material, we'll do our best to answer the questions. And if we don't get to them, we'll try and answer the questions at the end or respond to you after the session is over. We'll also follow up and circulate a copy of the materials as well as a replay of the session in the coming days. Finally, stay tuned as well in the next couple of days for our annual alert on reminders for proxy season and annual report season. That will be coming out, as well as our session on preparing for annual report and proxy season. With that, I'm going to hand it off to Laura, who's going to get us going today.
Thanks, Anna. Slide 4, please. We're just going to start by thinking, why do companies repurchase their shares? And of course, the primary reason is that management and the board think the company's stock price is undervalued. And sometimes they may have investors strongly pushing for a return of capital. But buybacks can also increase liquidity, and they can support a company's stock price in a bear market. And it's also easier for companies to take an opportunistic approach to returning capital with buybacks than it is with dividends. It's much easier for a company to simply get out of the market when it wants to stop buying its shares, but it can be a big deal to stop paying a regular dividend. And buybacks provide a source of shares that can be used for compensation, dividend reinvestment, or acquisition. And this minimizes dilution that would otherwise occur if newly issued shares were used. Buybacks can increase the key measure of earnings per share, a number that many investors pay attention to. But they also may drive incentive compensation for executive officers, and that's generated criticism of buybacks. Slide 5, please. This chart will give you a visual representation showing how share buybacks have increased over the years. Slide 6. And with the record number of buybacks have come headlines, which have attracted legislative and regulatory and academic and media attention. And we have opponents who argue that buybacks promote short-termism and benefit wealthy executives, and that the money could be better spent on research and development or employee compensation. Others, however, have pointed out that buybacks benefit all stockholders, including retail investors, by providing greater liquidity and reduced volatility. Slide 7. And I'll point out that in the adopting release, the SEC referenced the high dollar volume of buybacks that's occurred and asserted that at least partially buybacks may be motivated by factors other than long-term value. Slide 8. In terms of background, these amendments for share repurchase disclosure were proposed in December of 2021. Following several comment period extensions, the SEC adopted the final rule in May, and that was by a 3-2 party line vote. Slide 9. So what companies need to comply with the share repurchase disclosure amendments? The answer: all issuers that repurchase equity securities that are registered under Section 12 of the Exchange Act. And that's a very broad scope. These rules apply to SEC reporting companies of all sizes, and that includes smaller reporting companies, emerging growth companies, foreign private issuers, exchange-traded, registered, closed-end investment management companies. There was a footnote clarifying in the adopting release that it did not impose the repurchase disclosure requirements on Canadian issuers that file using the multi-jurisdictional disclosure system. Slide 10. As for key takeaways, the final rules require tabular day-by-day reporting of buybacks, but that's on a quarterly or a semi-annual basis, depending on the type of issuer. In addition, detailed buyback disclosure in narrative form is also required. And this is important, there's no materiality threshold. Slide 12, in terms of key differences from the proposal, the headline change is the SEC did not adopt next business day disclosure of buybacks, which it had proposed. Daily information is still needed for buybacks, but companies have longer to compile and proof their disclosures. Slide 13. Another important difference from the proposal is that the final rules treat the disclosures as filed rather than furnished, so there's the liability issue that goes along with that. Another change was the timing of a checkbox on the chart for director and officer transactions in company shares subject to repurchase, so that it's triggered by trades occurring within 4 business days before or after a repurchase announcement, rather than the 10 business days originally proposed. And there were some changes to the narrative disclosures. Slide 15. So the forms that are used for buyback disclosures and the timing, slide 15, yes, depend on the type of issuer, and that's broken down into 3 categories. So companies that file on domestic SEC forms, and that would include some foreign private issuers that use the domestic SEC forms, they have to provide the tabular day-by-day buyback disclosure quarterly, and this goes on new Exhibit 26 to Forms 10K and 10Q, as well as narrative disclosures in the main text of the report. Foreign private issuers that report on Forms 20F and 6K must provide the tabular day-by-day buyback disclosure quarterly on new Form FSR, and it can incorporate applicable information on 6K from 6K if it satisfies the rule, but you have to file the Form FSR. And then the foreign private issuers actually provide their narrative buyback disclosures in their annual report on 20F. And then you also have listed closed-end companies, and they must provide day-by-day buyback disclosure, as well as narrative disclosures annually and semi-annually on Form NCSR. Slide 16. Recently, August 30th, the SEC issued 3 compliance and disclosure interpretations on Form FSR, making clear that the form doesn't have to be filed for a quarter where neither the foreign private issuer or an affiliated purchaser repurchase the registered securities, while also clarifying that if there were buybacks in the fourth quarter, the foreign private issuer has to file the Form FSR. It can't wait for the 20F filing. So slide 17 now. This is the chart which I took from Exhibit 26 of Item 601 of Regulation SK. It shows what the tabular disclosure must look like. There's going to be a row for each date on which a repurchase was executed, and then there's 9 columns of specific disclosure for each daily repurchase. And then there's the checkbox at the top that I mentioned a moment ago regarding trades by directors and Section 16 officers within 4 business days before or after the company's announcement of a buyback or an increase in the buyback program. Slide 18. This is the old chart that we were using under item 703A, just to give you a sense as to how much more information we're going to now be giving. But let's get back to the new rules and move to slide 19 to go over the detail that you're going to have to provide. So you've got the date of the repurchase, the class of securities purchased, the total number of shares, and whether or not the repurchase was made to a publicly announced plan or program, the average price per share, the total number of shares purchased as part of a publicly announced program, the aggregate maximum number or dollar value of shares that are still available to be purchased under the publicly announced program. Slide 20, please. The list goes on. The total number of shares purchased on the open market other than in tender offers or to satisfy a company's put obligation, the total number of shares that the issuer intended to qualify for the Rule 10b-18 safe harbor, and the total number of shares pursuant to a plan intended to satisfy the affirmative defense conditions of Rule 10b5-1C. And then you have to have a footnote for the date of adoption or termination of any plan that's intended to satisfy the affirmative defense conditions of buybacks listed in the table. So that's a lot of information multiplied by the number of different days during the quarter there were buybacks. So let's move to slide 21. There's also a new section D to item 408 of SK that requires quarterly disclosure of the company's adoption or termination of a 10b5-1 trading arrangement. In addition, the material terms of the trading arrangement has to be disclosed, including the date of adoption or termination, the duration, the aggregate number of securities to be purchased or sold. But good news is it's not requiring the price at which the executing party is authorized to trade. Item 408D also requires disclosure if a plan, 10b5-1 plan, was adopted or terminated, whether or not a buyback under that plan occurred during the prior quarter. So let's move to slide 22 because there's also amendments to 703. This also would be reflected in 20F and item 14 of NCR, and it requires expanded information. And what I'd like to focus on is that the required narrative disclosures include objectives and rationales for each repurchase plan or program and the process or criteria used to determine the amounts. And that can vary over time or even different purchases within the quarter. And then there's disclosure regarding the plans, the date of the announcement, the dollar amount, the expiration date. Slide 23, please. It is also a requirement that companies disclose plans that expired, the date of expiration, and any publicly announced program the company decided to terminate prior to expiration or which the company doesn't intend to make further purchases. And then policies relating to purchases and sales of their securities by their officers and directors during a repurchase program, which I think companies are going to have to think about. Not everybody has that. But moving on, slide 24, I'll just mention that this is an XBRL requirement, so you have to just tag these disclosures in inline XBRL. And let's move to slide 25 just to go over the compliance dates. So when do companies have to start doing this? Companies that report on domestic forms have to comply with the new buyback disclosures on Form 10Q and 10K, beginning with their first filing that covers the first full fiscal quarter beginning on or after October 1st, 2023. So for calendar year end companies, this means the 10K coming up will be the first report, and it's going to cover repurchases in the fourth quarter. Foreign private issuers reporting on 20F and 6K will provide their tabular disclosure in new form FSR, beginning with the form that covers the first full quarter that begins on or after April 1st, 2024. And the narrative disclosures relating to that form FSR filings will be the first 20F filed after the first FSR has been filed. So for calendar year end companies, the foreign private issuers will file their first form FSR with respect to the second quarter of 2024. That'll be due on or before August 14th, 2024. And that'll be followed up with the narrative disclosures in their 20F for the year ended December 31st, 2024. Listed closed-end funds have until the period that begins on or after January 1st, 2024. And with that, I'm going to turn the program back over to Anna.
Thanks, Laura. So we'll go on to the next slide and the one following that. So clearly, there's an enormous burden for public companies to comply with all of the disclosure requirements that Laura mentioned. And for that reason, the Chamber of Commerce, together with various other trade associations, filed suit. And they filed suit on August 9th. It's an action that's titled Chamber of Commerce of the United States of America v. SEC. So they filed for review of the SEC's actions in connection with the share repurchase disclosure rulemaking. And they raise a number of issues, as the slide indicates. First, they're challenging the sufficiency of the SEC's cost-benefit analysis, claiming, first off, that it didn't sufficiently consider the economic studies that the chamber and other trade associations put forward, and also that it was undertaken, the SEC's analysis was undertaken without regard to the excise tax, which is something that Brennan is going to talk about. So it failed to consider how the excise tax would affect corporate decision-making. And that if the SEC were to take all of that into account and conduct proper cost benefit analysis, they should then allow enough time for public comment before rulemaking. They also raised a constitutional issue, claiming that the SEC's rulemaking raises First Amendment issues because it raises free speech concerns. There are also various state amicus briefs that were filed, and those raise entirely different arguments, which are really interesting, relating to the federalization of corporate law. Those are interesting because they say that the decision making about how a company uses its funds, and whether, for example, it chooses to dividend or to engage in share repurchases as a return to shareholders, is a matter for Delaware, for example, for most companies that are formed in Delaware, and shouldn't be something that the SEC should really have a view regarding, and that the SEC is encroaching on many matters of state law, of Delaware law. And they give other examples like cyber. So that's interesting because we've commented on this in various of our presentations and alerts that the SEC seems to be peering into corporate boardrooms more and more. So on the next slide, what did the SEC have to say about all of this? So the SEC responded to the chamber's arguments. The SEC stated that the First Amendment argument really was sort of meritless because there were legitimate state interests here. There wasn't an ideological reason. Buybacks aren't ideological. I think that's in the eye of the beholder. If you listen to some of the arguments in Congress, if you read some of the proposed bills that have been put forward in the House and in the Senate relating to buybacks, I think you might come up with a different view. And the SEC says that it did consider the impact of the excise tax and defends its cost benefit analysis. There were amicus briefs that were filed by a group of academics, including Rob Jackson, former Commissioner Jackson, defending just the cost benefit part. He didn't address the First Amendment piece, defending the sufficiency or robustness of the SEC's cost benefit analysis. So we shall see how all of this plays out. Obviously, the SEC has many challenges to defend against. So it's interesting. And there are lots of arguments to read through in the various amicus briefs. So what effect will all of this have on issuer stock repurchase plans? We'll go to the next slide on this. During the comment period and in the aftermath, after we had the final rules, a lot of questions have been raised as to whether this is going to have a chilling effect on issuer repurchases. The narrative disclosure that Laura noted may cause research analysts, rating agencies, even investors potentially to put undue focus on why the issuer chose to structure a particular transaction as it did, whether it chose to rely on the 10b-18 safe harbor, why, or whether it chose to rely on the affirmative defense under 10b-5, which Dave is going to talk about. And to the extent that it didn't, does that suggest something? The negative inference question. And then maybe more importantly, is all of this going to lead to more enforcement activity on the SEC's part? In recent years, we've seen more and more SEC enforcement activity being brought against companies for failings with issuers' disclosure controls and procedures, with issuers failing to have robust disclosure controls and procedures around the use of material non-public information on transactions entered into by insiders. And so will this lead to more of that? And many cases brought on simple negligence grounds under Section 17. So next slide, I'm going to talk for a couple of minutes on ASRs. So obviously, a company can do a straight up open market repurchase, but a company can also do an accelerated share repurchase. Laura talked about some of the bad press surrounding repurchases generally. ASRs are another way to do a repurchase and oftentimes accomplish the goal more efficiently because they provide more certainty. In an ASR, the company engages a broker dealer. The dealer is acting as a forward purchaser, as a derivatives counterparty, and effectively is acting as the seller of the company's shares. The company is acting as the purchaser. It provides more certainty because the company is buying all the shares upfront at a particular price. So if we go into the next slide, this is the trajectory or the lifespan of an ASR. At the beginning, the company pays a predefined dollar amount, the purchase price, to the dealer. The dealer's borrowing all the stock, the company stock, from the market, from stock lenders, and delivering over that stock to the company. And then over time, the dealer is going into the market to cover the borrow. And then at the end, settling up with the company. So if you go to the next slide, 10b-18, the safe harbor, doesn't apply to these kinds of transactions, which are derivatives transactions. However, the market really applies 10b-18 by analogy, and every ASR transaction will reference 10b-18, and dealers conduct their activity subject to the 10b-18 limitations, again, more as a precaution. Next slide. Issuers also usually tend to, we'll go to the next one, tend to rely on 10b5-1 in connection with these programs. And dealers will ask for 10b5-1 type reps and warranties in connection with these programs. So will they continue to do so? That's an open question. 10b-18, as I said, doesn't strictly apply. Is there a benefit to continuing to do so in light of this new backdrop? Is there a benefit to continuing to rely on 10b5-1 in light of what you're going to hear from Dave? Again, open question. Next slide. The final rules worked out better than we all feared as far as ASRs. So an ASR still has to be disclosed, even with the final rules. Now, presumably, it's easier. You can add just the narrative disclosure and you can disclose it as one transaction. However, it's a question mark in terms of whether issuers will continue to rely on the 10b5-1(c)(1) affirmative defense, and whether they'll choose to rely on 10b-18 or whether just force of habit and conservatism will prevail, and we'll continue to keep all of this in the documents as we always have. And with that, I'm going to turn it over to Dave to talk about 10b5-1, which also obviously ties into this little discussion.
Thank you, Anna. You will all recall that prior to adopting the new disclosure rules for issuer share repurchases, the SEC adopted amendments to Rule 10b5-1. While a full discussion of those amendments is beyond the scope of this presentation, I'll quickly recap a number of the conditions that apply to individuals who intend to rely on Rule 10b5-1 but don't apply to the issuer. The relevance of this is that for the disclosure obligations of the issuer that I'll discuss next. So amongst the new conditions that have imposed on individuals are cooling off period for directors and executive officers. That would be the later of 90 days and 2 business days after the filing of the Form 10Q or Form 10K, covering the period the plan was entered into, but up to a maximum of 120 days. For all others, other than the issuer, the cooling off period is 30 days. There's also a prohibition on overlapping plans with certain limited exceptions, and single trade plans are limited to 1 during any 12-month period. Again, the important takeaway here is that none of those conditions apply to the issuer. Next slide. Or concurrently with adopting those amendments to Rule 10b5-1, the SEC did impose new disclosure requirements on issuers in the form of new item 408A. Under 408A, issuers now need to disclose in the Form 10Q or the Form 10K for the 4th quarter whether any of their directors or executive officers has adopted or terminated any Rule 10b5-1 trading arrangement or a non-Rule 10b5-1 trading arrangement. The disclosure must include the date, the name, title, date of adoption or termination, the duration, and the number of securities. And this disclosure needs to be provided in inline XBRL. Now, questions have arisen over what the meaning of non-Rule 10b5-1 trading arrangement is. The adopting release refers to pre-planned trading arrangements. It also noted that the definition accords with the requirements of Rule 10b5-1 as it was originally adopted in 2000, but this still leaves questions as to whether, for example, a limit order that was intended to be executed on the same day is not filled, but instead is executed a couple days later. Question whether or not that constitutes a non-Rule 10b5-1 trading arrangement. Before, there was no real need to make a definitive conclusion about this, unless there was an allegation of insider trading. But now that is important to decide whether or not it has to be disclosed by the issuer or not. Moving on, to the next slide. The other disclosures that I'm about to talk about are all annual disclosures imposed on the issuer. The first of these is 402X, which is required if the issuer makes option awards to any of its named executive officers in close proximity to the filing of a report that contains material non-public information. If it does so during it'll need to include in the following year's proxy statement a new table. Again, this is triggered if the option award is made to a named executive officer in the period beginning 4 business days before the filing of a periodic report, such as the 10Q or 10K, or the filing or furnishing of a current report on Form 8K that contains material non-public information other than the 8K disclosing the grant itself, and ending 1 business day after filing such report. The tabular information would need to include the grant date, the number of securities granted, the exercise price, and the fair value at grant date, all of which is otherwise going to be included in the proxy state, so that to that extent it's completely duplicative. But the other new item will be you'll need to show the percentage change in the closing price of the underlying common stock between the trading day prior to the grant and the trading day following the grant. The purpose of all this is to help investors identify whether or not the issuer is engaging in what has been called spring loading or bullet dodging. Spring loading being granting options just before the release of positive information, and bullet dodging means the disclosure of negative information just before the grant of an option award. The next slide, please. So whether or not a company has the need to file this, include this tabular information in its proxy statement, it still will need to disclose its policies and procedures on the timing of option awards, including how the board determines when to grant options, whether and if so, how material non-public information is taken into account, and whether the issuer has timed disclosures of material non-public information for the purpose of affecting the value of executive compensation. One thing to point out here is that when we're talking about option awards, the rules include the grants of stock appreciation rights and similar instruments that have option-like features. Now, if the issuer doesn't make option awards as a matter of course, presumably a simple statement to that effect will be sufficient to satisfy this disclosure requirement. The next slide, please. Another new annual disclosure requirement imposed on issuers involves insider trading policies. Issuers will now need to disclose whether or not they've adopted insider trading policies and procedures for directors, executive officers, and employees, or the registrant itself, and that are reasonably designed to promote compliance with insider trading laws. If the issuer hasn't adopted those policies, then it must explain why it hasn't done so, and it must file those policies and procedures as an exhibit to its Form 10-K. The disclosures need to be provided in inline XBRL. There's a similar annual disclosure requirement now for foreign private issuers that corresponds to the 408B. Curiously, the corresponding disclosure requirement for foreign private issuers doesn't include a reference to the registrant itself. The adopting release doesn't explain the difference. Perhaps it was an oversight in the haste to adopt the rules. Another thing to point out here is that these policies and procedures are designed designed to cover not only purchases and sales, but also other dispositions such as gifts. So your policy doesn't cover that. You probably need to address that in a revised policy. On the next slide, please. Some things to think about in terms of disclosure controls prompted by these new disclosure requirements. One, you should consider the adequacy of your pre-clearance policy for directors and executive officers to identify the adoption or termination of trading plans that need to be disclosed quarterly. Most companies I know have pre-clearance policies and require directors and executive officers to pre-clear their trades. So presumably any 10b5-1 plan would be picked up by those pre-clearance. But if not, people might need to consider whether or not some sort of confirmatory communication is required every quarter. I know some companies announce in advance to their directors and executive officers when the next trading window is going to open up. Presumably those companies could piggyback on that disclosure and that communication to confirm there was no 10b5-1 plans entered into or non 10b5-1 plans entered into in the prior quarter, but that depends on when those communications occur relative to when you file your 10Q. In terms of the annual disclosures, think about the fact that these tabular disclosures of option awards made close in time to the release of material information probably not going to occur every year. They'll be episodic, so you can't rely on marking up just prior year's proxy statement because prior year's proxy statement may not have had one, though it may be applicable now for the current year. Fortunately, this is an easy thing to add to a checklist. You could look on January 1st, compare Form 4s, which should show all the option grants made to named executive officers, and just compare those with the dates of the issuer's SEC filings. Finally, the compliance dates. these compliance dates for non smaller reporting companies will kick in as for any full fiscal period beginning on or after April 1. So for quarterly disclosures of director and officers entering into trading plans, those should have already kicked in for pretty much everyone by now, if you're not a smaller reporting company. As far as the annual disclosure requirements under 408 and 402X, fortunately, those won't kick in until the disclosure filings made in 2025 for the 2024 fiscal year for calendar companies. And smaller reporting companies, it follows the same pattern, but they get additional 6 months for both the quarterly and the annual disclosure requirements.
Thanks, Dave. My name is Brennan Young, and I'm in the tax group here at Mayor Brown. And I'm going to be talking a little bit of a brief primer on the stock buyback excise tax, which is not as exciting as 10b5. I didn't know because Dave was talking about spring loading and bullet dodging, kind of sounded like the Matrix, which is pretty awesome. If we could go to the next slide. So a little mini agenda. The Inflation Reduction Act was enacted last summer, and it included a 1% stock buyback tax, which we're going to go over. We're going to talk about the legislation itself, just kind of the general rule, kind of the statutory exceptions to that rule that were actually included in the bill. Then we'll talk about a couple of recent pieces of guidance. One was a notice just at the end of last year. And then one was an IRS announcement from this summer with a little bit of extra information in it. So heading to the next slide, let's just start with the basics there on slide 48 or 49. So in general, it's a non-deductible 1% tax on the value of stock of a covered corporation that's repurchased by the corporation or its affiliates during a taxable year. A covered corporation is generally a domestic corporation that is traded on an established securities market. In some limited cases, acquisitions by a non-US company of its own shares can be captured also if there's a domestic affiliate involved, in particular if the domestic affiliate is the one that does the acquiring of the shares. The buyback tax applies beginning in 2023, and it didn't have a grandfather rule. So that was something that people began to get worried about because there were some gaps in exactly how to apply the rules when the rules came out. And obviously 2023 is well underway now. Unfortunately, we do have a little bit of extra guidance, but as a little bit of a spoiler, we're still waiting on proposed regulations that can fill in more of the gaps. What does the buyback tax apply to? Generally, anything that is a redemption under the code, which is pretty broadly defined, and it includes any acquisition of shares for cash or other property other than certain acquisitions of your own stock rights. And this stock buyback tax also applies to economically similar transactions, which we'll get into in a minute. If we can go to the next slide. What are the statutory exceptions? So the big headliner is that the excise tax only applies on a net basis. So if you buy back shares and also issue more shares in the same taxable year, that's important. It can't be spread across 2 years. But if you do that in the same taxable year, then it's only the net amount that you repurchased over what you issued that the stock buyback tax will apply to. A few other exceptions. If your buybacks don't exceed $1 million, then you're not going to be covered. Buybacks that are part of tax-free reorgs, that's another thing not covered. If REITs or RICs, regulated investment companies, real estate investment trusts, are buying back their shares, that's also not covered. If your redemption is treated as a dividend for tax purposes, which those are kind of complicated rules. I don't really have time to delve into it, but certain redemptions, if you only redeem a little bit, can be treated as substantially equivalent to a dividend, it's called in the code. A lot of rules winding down that path, but those are excluded. Also, certain contributions to employee benefit plans, and there may be an exception coming in the regulations. The code provision granted the Treasury authority to make an exception for dealers and securities acting in the ordinary course of business. So going to the next slide, let's talk about a little bit of later news. So that came out again in the summer, and everyone was pretty panicked because there were some uncertainties with the rules, particularly how they applied to SPACs and ASR transactions that made people a little worried. At the end of last year, so just in time for us to get into the applicable window of 2023, they issued notice 2023-2. It provides some interim guidance, excluding certain transactions. Importantly, I mentioned that economically similar transactions are covered. It excludes from those complete liquidations, which is important because some companies, like everyone's favorite SPACs, are formed with the intent to find a target. But then if you don't find a target, the idea is to just wind things up and liquidate and get the investors their money back. Previously, before this guidance, it wasn't entirely clear that situation would be excluded. So you might have a redemption where you can only give back 99% of money to SPAC shareholders. But fortunately, this notice did announce an exception for complete liquidations. It provides a list of transactions that are economically similar, which is helpful. And I don't have time to get into details on all of those. But another thing that the notice did add is a per se funding rule. So the notice mentions that if a domestic affiliate funds a non-US company's repurchase of its own shares, that can potentially be subject to the stock repurchase excise tax. And in the notice, they say that there's a per se funding rule that if the principal, so that rule I just mentioned is focused on a principal purpose of avoiding the excise tax. And the per se funding rule says that a principal purpose will be deemed to be found if the funding by the affiliate is within 2 years. And it's not entirely clear if that's 2 years total, so 1 year on each side, or 2 years back and 2 years forward. So hopefully, when proposed regulations come, which are still in the works, but everyone's hoping to see them, they'll clarify that rule. And then finally, the notice also mentions that tax reporting for the stock buyback excise tax. Laura mentioned there's already a lot of record keeping and reporting that needs to be done. Tax is no exception to that. There's a quarterly excise tax form, which currently that form is mostly used for like petroleum and chemicals and stuff like that. But in that bucket now will be our stock buyback excise tax of 1%. It's form 720, and that's filed quarterly. And then we also have the last, if we can go on the next slide, the last piece of guidance in the latest, this came out just a couple of months ago. The main thing that announcement 2023-18 does is it says, I just mentioned that the notice said, hey, you're gonna have to report this stuff quarterly. Well, people were worried exactly how do we report it quarterly when we don't have the proposed regulations I mentioned. Well, this notice says that nobody has to do any reporting and paying of the excise tax until the regulations actually arrive, which is very helpful. It does mention that companies are going to need to keep complete and detailed records of all stock buybacks, which, based on Laura's presentation, I think that a lot of companies will be keeping records in any case. And then last thing I'll say is looking ahead. One thing I just want to point out is now that the excise tax is in the code already, so it's 1% now. We've already seen proposals. Now that's in there, if Congress needs money, which of course they never would, but if they do, people might say, why don't we bump up the excise tax from 1% to, I think some proposals recently were up to 4%. So apart from that, hopefully the proposed regulations provide some guidance to fill in some of the gaps. And with that, I'll turn it back over to Laura and Dave to round us out today.
Okay, thank you, Brennan. Let's go to slide 54. We're going to close out the program with some slides on policy considerations and disclosure controls. In terms of policies, keep in mind you've got that objective and disclosure you have to put in, why you're doing this. So it's a good time to start thinking about what you're going to say, what the benefits are for the repurchase, why not a dividend, what's the best way to articulate the company's position, so that it goes over well with investors and other stakeholders. Next slide. Other things to consider would be what other things could you use the money on, and how do those uses compare to investment opportunities that would be considered by the issuer. In other words, the repurchase money, would be better used for capital expenditures or other, are there any other capital expenses coming up, and what are the accounting or compensation metrics? Next slide, just in terms of Anna already addressed, I think, the first bullet point here in terms of whether to continue relying, but we also have talked today in terms of policies relating to repurchases and sales by officers and directors during company buyback programs. You have to disclose those if you have them, but you don't have to add any specific restrictions. So it's something companies need to think about whether they want to implement something, though of course that can be challenging if a company has a regular buyback program that continues throughout the year. So those were some of the policy considerations, but in terms of disclosure controls, if we go to the next slide, we've just talked in terms of record keeping earlier when I talked about the tabular disclosure, and Brennan's just mentioned that. So you've got to have a process in place to gather the information, and you have to have a process for narrative disclosure. Those objectives and rationales can change from filing to filing based on the circumstance of the period. So, consider, what control you're going to have to make sure that happens. Let's go to slide 60, because one of the things from a board point of view is, do you want to document, do the boards want to document their decisions about buybacks in the resolutions and the minutes more fully than perhaps they've done in the past? Do they want to seek more formal advice from financial intermediaries that act as their repurchase agents? Do they want to, for example, request a board presentation on what the expected impact of the repurchases would have, and what other uses of cash and similar matters may be? Why don't we go to the next slide and just consider whether or not the objective and rationale disclosure is going to want you to make any changes to what a buyback program would be. It seems to me that you have to keep in mind that these disclosures impact all kinds of stakeholders, the investors, the analysts, and others. You want to be sure that there's a connection between what you're disclosing for your objectives and your repurchase and how they line up with those tabular disclosures, and whether different disclosures are needed. So the consistency is very important. And I think it is particularly useful, as is always the case when you have a new disclosure, is work on sample language well in advance. Be sure that you have the time to get input from various departments within the company. It seems to me investor relations, the finance department, the law department are all people that should be providing input on that disclosure. And you should also, seek advice of outside counsel. Ultimately, you want to get your senior management and your directors on board for that. Can we go to the next slide? I just want to be sure that I think we should be on slide 62. That we're avoiding boilerplate, and the release really does go into certain kinds of things that you can do to avoid boilerplate. And you want to avoid boilerplate not only with other companies, it's not a one-size-fits-all disclosure, but also in terms of what you are trying to convey from period to period. Next slide, please. We did provide some sample language on slide 63, but I want to emphasize this is like not a one-size-fits-all disclosure, but it's perhaps an idea of the kinds of things you could talk about, such as fiduciary duties, that buybacks, are one of several ways we can deploy capital, and then discuss what some of those others are. But that might not be all that relevant to a particular company. So it's something that you just want to assess. Obviously, the first year of disclosure, you can't see what peer companies are having. You'll want to follow that once that those disclosures happen, but you need to work on something that is very customized for your consideration. Let's go to slide 64. Just to mention that we've talked today about all sorts of specific disclosures that are needed, but never lose sight of the fact that you've got existing obligations under SEC rules, that if there's any other information that is necessary to make the buyback disclosures not misleading, that you need to put those disclosures out there to the extent they're material. And I also want to emphasize that there are stock exchange requirements to promptly disclose material news. And so if there is material news relating to buybacks, you can't just wait till the next quarter if it's something that the stock exchange wants you to disclose, and they would want you to disclose, a press release announcing a buyback program or a continuation, an increase of a program or an extension of a date, because buybacks are considered material. And I'd also say that it's important at this point to monitor SEC guidance. There have already been some compliance and disclosure interpretations, and there may be more. And once these disclosures get made and reviewed by the SEC, there may be comment letters that will impact disclosures on a going forward basis. And I just want to give David a time, if you have any. I know you did mention some disclosure controls in your slides, but you might want to emphasize any or any others.
Well, I thought we had some questions that maybe we can address. One of them is, what are the key considerations with respect to the expanded disclosures and potential corporate issuers' considerations with potential investors employing the information to trade ahead of a new or ongoing program? Yeah, that was one of the concerns expressed by commentators after the initial proposals, and that would have been particularly significant if under the original proposals, companies were required to more or less report their buybacks in real time. That's somewhat ameliorated by the final rules, which require disclosures on a day-by-day basis, but only quarterly. Yeah, there's a concern that investors can reverse engineer what a company's buyback algorithm or program is and trade ahead of that. I think what probably companies will need to do if they want to avoid that is not put in place the same type of plan if they do it on a quarterly basis, not put in place the same plan every quarter, but vary it up a little bit so that it's less easy to reverse engineer later.
I agree with you that this is still an issue and not as bad as it might have been if we had next business day disclosure. But if somebody is regularly in the market, and particularly think about, the end of the quarter isn't that far from when the reports get filed, people can notice that somebody stopped buying back their shares after regularly doing so for a long period of time, and people are going to start trying to wonder what's up. Is there a transaction that, is there material non-public information that caused them to stop trading? And there's, it is a real concern that the additional information that is available can lead to additional scrutiny, and that could be both from people reverse engineering and trying to get ahead of the market, and also for people who want to look at data and see what claims, etc., they might be able to assert. I also want to point out this slide 67, which will be in your slide deck when you get it, but there's a number of articles and alerts that we've written, talks that we've had. So you can link on those and also take a look at our free writings and perspectives blog. So I think that's all we need to get through today. So again, thank you to everybody who has spent the last hour with us.
Yes, thank you all.